Imagine you run like a heavy industrial manufacturing plant.
Got it.
You make all the massive, unglamorous equipment, right? This stuff that just sits on rooftops or behind chain link fences.
Right, the stuff nobody really looks at.
Exactly. And then one day, a rep from one of the most powerful tech companies on earth just walks into your office.
I can picture it.
They sit down, drop this figurative briefcase containing $165 million in cash right on your desk, and they just look you in the eye.
That's a good day at the office.
Right. But here's the crazy part. They don't even want to buy what's on your factory floor today.
No.
No. They're paying you that cash simply to guarantee that, like, 3 years from now, you will agree to sell your products to them and absolutely no one else.
Wow. So they're essentially hoarding your future manufacturing capacity.
Exactly. And this isn't some hypothetical thought experiment for you listening out there. This is a literal transaction that just happened right in the middle of this massive artificial intelligence boom.
Yeah, and it really reveals this massive kind of hidden panic that's just sweeping through the tech industry right now.
So today on the deep dive, we are looking at the Q4 fiscal 2026 earnings call for Modine Manufacturing.
And, you know, it's such an unprecedented move. It perfectly illustrates this total shift in where the true bottlenecks of the digital economy actually are right now.
Because, I mean, we spent the last few years totally obsessing over silicon.
Oh, absolutely. It's always been about, you know, who can design the fastest GPU or who can secure time at the foundries in Taiwan.
Right.
But silicon is completely useless if you can't control the physical environment it operates in.
Yeah, if it just melts on the rack.
Exactly. So the transaction you're describing, it's a panic buy, but it's not a panic buy for microchips. It's a panic buy for thermodynamics.
A panic buy for thermodynamics. I love that. And to figure out exactly why these sophisticated tech giants are doing this, we really need to get into this Modine earnings call.
We do.
Because if you follow automotive or heavy-duty machinery, you might know Modine as this legacy company building like radiators for bulldozers.
Or commercial HVAC units, yeah.
Right. But digging into this specific call, you see that they've quietly engineered themselves into becoming this critical failsafe for the whole global expansion of AI.
They really have. They're the ultimate toll booth for the future of the internet at this point.
Okay, let's unpack this, because the best place to start is just looking at the sheer velocity of their transition. The headline numbers here, they do not look like a traditional industrial company.
Not at all. I mean, they look way more like the growth curve of a Silicon Valley software startup.
Which is wild for a company bending metal.
It's highly unusual. I mean, you're dealing with raw materials, supply chains, literal factory floor assembly. But Modine just reported their 4th consecutive year of record-breaking revenue and adjusted operating profits.
4 years in a row.
Yeah. But the real story for anyone tracking this is where that growth is concentrated.
The Climate Solutions segment.
Exactly. So that segment, which houses all their data center operations, it jumped 43% for the full year.
43%.
Yeah.
And a lot of that was organic, right?
Right. 32% of it was organic, meaning they didn't just go out and buy a bunch of smaller companies to juice the numbers. Their actual existing product lines just saw this massive internal demand.
And the raw engine behind that organic growth is just, well, it's entirely data centers.
Oh, yeah.
That specific subsegment grew by 73%. It hit $1.1 billion.
$1 billion.
A company known for heating warehouses just crossed $1 billion purely by preventing the internet from overheating.
It's incredible.
But, you know, it's not just the top line revenue that caught my eye. It's the profitability curve.
Yeah.
They cited a 40% compound annual growth rate in their earnings over a 4-year period.
The TAGR, yeah.
Right. And in heavy manufacturing, generating massive revenue is, well, it's relatively easy if you're just willing to slash your prices and take on terrible margins.
Anyone can sell $1 for 90 cents.
Exactly. But growing your actual core operational cash flow,
The EBITDA.
right, the EBITDA,
Yeah.
by 40% year after year, that suggests they have an immense amount of pricing power.
Oh, absolutely. And for you listening, when we say EBITDA, we're talking about earnings before interest, taxes, depreciation, and amortization. It's basically the truest measure of the cash a company's operations are actually spitting out.
Stripped of all the accounting noise.
Right. And that kind of pricing power, it's the hallmark of operating in a severely supply-constrained market.
Because there's nowhere else for these customers to go.
Exactly. When your customers are hyperscalers, you know, the trillion-dollar tech giants building out global cloud and AI infrastructure, they are surprisingly price insensitive when it comes to these critical bottlenecks.
Really? Trillion-dollar companies don't care about price.
I mean, they care, but think about it. If a hyperscaler is building a $2 billion data center campus, they are not going to haggle over a few percentage points on the cooling equipment if it means delaying the launch of that facility by 6 months.
Because the downtime costs them way more than the chiller does.
Exactly. Modine has found themselves in this position where the cost of their equipment is literally a rounding error compared to the opportunity cost of their customers' downtime.
That makes total sense. That dynamic is exactly what drives a 40% compound growth in profitability.
Yeah, it's a very bullish signal.
But they aren't just, resting on their laurels or relying on being in the right place at the right time. There's clearly this aggressive assembly of assets happening behind the scenes.
Oh, the acquisitions.
Yeah. The transcript mentions they acquired 3 distinct companies earlier in the fiscal year. We've got Absolute Air, LB White, and Climate by Design.
Which added some real revenue.
An incremental $119 million, actually. And it looks less like traditional corporate expansion and more like, a highly targeted military acquisition strategy.
Like they're assembling an Avengers team for commercial HVAC.
Yes, exactly. They're buying up these specialized engineering teams and highly specific market access points.
Well, the strategy there is about capturing the entire thermal envelope of a commercial building.
The entire envelope.
Right. Because if you are a facility manager or an engineering firm designing this massive complex, you really don't want to source your air handling from one vendor, your precision cooling from another, and then your heating elements from a third.
It's a logistical nightmare.
It is. So by rolling up these specialized firms, Modine creates this completely frictionless procurement process.
A one-stop shop.
Exactly. They can walk into a contract negotiation and offer an end-to-end engineered solution. And that inherently locks the customer into their ecosystem for long-term parts, maintenance, future upgrades.
Which sounds great on paper, right? But I want to push back on this a little.
Sure, go for it.
Because looking at a 73% growth rate in one specific segment data centers, while the rest of their industrial portfolio is just growing at a standard single-digit pace, that raises an immediate red flag for me.
The top-heavy critique.
Yeah. Doesn't that force a question about their structural integrity? If you become incredibly reliant on the capital expenditure cycles of maybe a half dozen massive tech giants, doesn't that expose you to catastrophic risk?
It's the classic concentration risk.
Right. Because if the AI training boom just plateaus, or if these tech companies suddenly decide, hey, it's a year of efficiency and they halt new data center construction.
Which Meta literally just did a year or two ago.
Exactly. Then an infrastructure provider that is this top-heavy could see their billion-dollar segment just evaporate overnight. So is this brilliant pivoting, or are they dangerously overexposed?
Well, that is the exact structural vulnerability that management teams lose sleep over. And you see Modine actively defending against that specific critique throughout the entire call.
How so?
Their primary defense mechanism is this operational philosophy they repeatedly refer to as the 80-20 discipline.
80-20 discipline.
Yeah, it's this really fascinating application of resource allocation. Instead of trying to be everything to everyone across all their legacy businesses, they continuously analyze their entire product matrix.
Looking for what's actually working.
Right. They want to identify the 20% of the portfolio that is driving 80% of the profitable growth.
Which right now is undeniably the data center cooling tech.
Without a doubt. So once they isolate that high margin core, they just ruthlessly redirect their engineering talent, their capital expenditures, their supply chain priority. All of it goes directly toward that 20%.
Okay, but I want to break down the mechanics of what ruthless redirection actually looks like on a factory floor.
It's messy.
Right, because it's easy to say you're prioritizing the high margin business on a conference call, but how do you actually manage the 80% of the business that you're basically deprioritizing?
You can't just drop them.
No, you can't abandon your legacy customers without destroying your reputation in the broader industrial market.
You manage it through what I'd call controlled friction.
Controlled friction. Okay, explain that.
So in practice, 80-20 discipline might mean taking a legacy commercial heating product that used to have, say, 50 different customizable configurations, and you just reduce it down to 5 standardized models.
Oh, okay. So you eliminate all the manufacturing complexity.
Exactly. You reduce the inventory of specialized parts you have to hold, and you completely streamline the assembly line.
And what if a customer really wanted one of those custom configurations?
Well, that's where you implement targeted price increases. You raise the price on those low-margin legacy products. If the customer stays and pays the higher price, your margins improve.
And if they leave?
If the customer leaves for a cheaper competitor, well, you just freed up factory floor space and labor that can immediately be retooled to build high-margin data center equipment.
Wow. So it's a win-win for Modine either way.
It is. It's a highly deliberate process of pruning the low-yield branches of the business to force all the nutrients into the most productive fruit.
So they're systematically shedding internal drag to feed this data center monster.
Perfectly said.
But, pruning a business to meet current demand is entirely different from guaranteeing that the demand will still be there after you've reorganized your entire corporate structure around it.
That's the gamble.
Right. You can build the perfect factory, but if the market shifts, you're left holding an empty, very expensive bag.
Yep.
And that tension is what makes that $165 million briefcase scenario we started with so critical. You don't just secure $4 billion in guaranteed future revenue without a profound structural panic happening on the customer's side of the table.
Oh, absolutely not. And this long-term agreement, or LTA as they call it on the transcript, it is the absolute centerpiece of their strategic positioning right now.
Let's really look closely at the parameters they released on this.
Yeah, so this is a commitment from a single, unnamed hyperscale customer.
Which could be Microsoft, Google, Amazon.
We don't know for sure, but it's one of the big ones. And they're committing to purchase over $4 billion of specific data center cooling equipment, primarily these massive chillers, stretching across calendar years 2027, 2028, and 2029.
That is a staggering amount of money for air conditioning.
It is. And to bind that agreement, the customer handed over that $165 million cash down payment today.
So the psychology behind this, from the hyperscaler's perspective, what is driving them to part with that kind of cash just to hold their place in line?
It's entirely driven by the concept of critical path constraints.
Right. Because if you are plotting out the construction of a gigawatt scale data center campus, it's like buying all the ice in town before a summer heat wave, but doing it 3 years in advance.
That's a great analogy. You're coordinating thousands of moving parts for these builds. You have to secure the land, negotiate power purchase agreements with local utilities, pour the concrete, route the fiber optics.
Massive infrastructure.
Huge, but none of that matters if the servers just melt the moment you turn them on.
Right. And they run incredibly hot now.
Exactly. When you're deploying tens of billions of dollars into advanced AI processors, the cooling infrastructure ceases to be this peripheral building component. It actually becomes the central gating factor for your entire operation.
So this LTA indicates that these hyperscalers are running their internal forecasting models, and they're seeing a massive deficit coming.
A severe looming deficit in global manufacturing capacity for advanced chillers. They're looking 3 years into the future and realizing traditional supply chains physically cannot build cooling equipment fast enough to match the pace at which semiconductor companies are churning out GPUs.
So they just use their cash to buy out the factory capacity years in advance.
They're buying certainty. Certainty that their AI investments won't be bricked by a lack of chilled water.
But the financial mechanics of how Modine absorbs a deal of that magnitude are fascinating, especially regarding that $165 million cash injection.
Oh, the accounting is super interesting.
Because when you drop that much capital onto a company's balance sheet for products that hadn't even been built yet, they're booking $4 billion of revenue today.
No, not at all. And the way the CFO explained the mechanics on the call provides a really great window into how modern corporate financing works.
Break it down for us.
So that $4 billion represents a committed backlog. It will be recognized incrementally over those 3 years as the physical units actually leave the loading dock.
Okay, that makes sense.
But the $165 million cash down payment creates this immediate accounting dynamic. It enters the balance sheet as cash, which provides massive liquidity, but it's instantly counterbalanced by a line item known as a contract liability.
Because even though they literally have the cash in the bank, they haven't actually earned a single dollar of it yet.
Right.
It represents an unfulfilled obligation, a physical debt of bent metal and running compressors that they owe to this customer.
Precisely. As they deliver against that $4 billion contract starting in 2027, they'll slowly amortize that liability, drawing down the initial payment against the invoices.
But what is the strategic benefit of getting that cash now?
The brilliance here is what that cash allows Modine to do today. expanding factory footprints, buying new tooling, hiring advanced engineering teams. All of that requires massive capital expenditures.
Right, CapEx.
Right. Normally, a company would have to issue bonds or secure high-interest commercial loans to fund that expansion, which eats into their future profit margins.
Up here.
By securing this upfront cash, the customer is effectively serving as an off-balance sheet, zero-interest bank.
Wow.
They are literally financing the exact factory expansion required to fulfill their own future orders.
Which is an incredible maneuver by Modine. Wait, here's where it gets really interesting, and I have to raise a critical pushback here.
Let's hear it.
It introduces a massive risk of capture. If you lock up your factory for one giant customer, if you allow a single hyperscaler to dictate the architecture of your factory expansion and reserve the lion's share of your future output, don't you alienate the rest of the market?
It's a huge concern.
Because there's an arms race happening right now between multiple trillion-dollar companies.
Yeah.
If I am the CEO of a competing tech giant, and I see Modine essentially becoming a dedicated subsidiary for my rival, I'm immediately going to find another supplier and aggressively fund their R&D just to catch up.
You have to.
Right. So Modine runs the risk of winning this massive battle, but losing the broader war for market dominance. How are they making sure they don't leave other tech giants out in the cold?
That exact vulnerability was actually the primary focus of the Wall Street analysts during the Q&A session on the call.
I'm sure they were all over it.
Oh yeah. They immediately pressed management on the risk of vendor lock-in. And management's response hinged on this concept they called a capacity matrix.
A capacity matrix.
Yes. They made it very clear that they did not simply hand over the keys to the factory. Before signing the LTA, they mapped out their projected total addressable market against their maximum possible physical footprint.
Okay.
And they announced they are currently in the process of doubling their entire chiller production capacity in North America by the end of this current fiscal year.
Wait, doubling the physical footprint of an industrial manufacturing line in less than 12 months?
Yep.
That is a brutal logistical challenge.
Yeah.
You're talking about pouring new foundations, routing high voltage power, setting up testing chambers, all while keeping the existing lines running.
It requires absolutely flawless execution. But the critical detail the CEO provided was that this doubling of capacity is designed to expand their output far beyond the requirements of this specific LTA.
Oh, I see.
They're using the guaranteed baseline revenue from customer A to completely de-risk the massive capital investment required to build a factory large enough to also serve customers B, C, and D. It's a calculated gamble. They're trying to build a boat so large that a $4 billion anchor doesn't sink it.
Exactly. They believe their aggressive expansion will outpace the restrictive nature of that single massive contract.
So what exactly are they building in these expanded factories that is worth $4 billion? To understand that, we really have to look past the spreadsheets and look at the intense, literal heat generated by artificial intelligence.
The physical realities of the built environment?
Right. And this brings us to the core engineering breakthrough they discussed, their new 3-megawatt chiller.
Yeah, to really appreciate the engineering here for you listening, you have to understand the fundamental shift in power density happening in these centers.
Explain that for us.
Historically, a standard rack of servers in a data center might draw somewhere between, say, 5 and 10 kilowatts of power.
Which is manageable. Very. You could cool that relatively easily by just pushing a massive volume of cold air up through the floor grates. But the architecture of an AI data center is entirely different. Racks packed with the latest generation of GPUs are drawing 40, 50, and very soon, over 100 kilowatts of power in the exact same physical footprint.
100 kilowatts in one rack.
Yes. And every single watt of that electricity is ultimately converted into heat. You are essentially dealing with an industrial furnace disguised as a computer.
That's crazy. Pushing cold air at a 100 kilowatt rack is like trying to put out a campfire by blowing on it.
Exactly. The air simply cannot carry the thermal energy away fast enough. The heat density requires an entirely different approach.
And that is where the 3-megawatt chiller comes in.
Right.
To conceptualize 3 megawatts, I mean, you are looking at the energy equivalent required to power thousands of residential homes.
It's immense power.
And they are managing that level of thermal transfer just for highly sensitive silicon. But the true engineering marvel isn't just the sheer capacity, is it? It's the physical geometry.
That's the kicker.
Management highlighted that this new unit delivers a 50% increase in total cooling capacity. But it only requires a 9% increase in its physical footprint.
Which is huge.
It's like upgrading a car's engine from a standard V6 to a jet turbine without having to change the size of the car's hood.
I love that analogy. And getting a 50% gain out of a 9% footprint increase requires fundamentally altering the mechanics of the heat exchange.
Yeah.
You have to move away from brute force and toward highly optimized thermodynamics.
What does that actually look like inside the unit?
Well, we're talking about utilizing densely packed microchannel coils that maximize the surface area of the refrigerant without taking up more space.
Okay.
Or integrating variable speed magnetic bearing compressors that basically eliminate mechanical friction and allow for incredibly precise, high-velocity thermal cycles.
I mean, the analogy I think about here is human lung capacity. You don't become an elite marathon runner by physically growing a chest cavity that is 50% larger.
Right, you'd be a monster.
Yeah. You become an elite runner because the internal surface area of your lungs, the alveoli, becomes vastly more efficient at transferring oxygen into your bloodstream within the exact same anatomical footprint.
That is exactly what Modine is doing. They're essentially redesigning the alveoli of the data center. They're maximizing the internal thermal transfer efficiencies, so the external box barely has to grow.
And the reason that 9% footprint metric is so vital is that physical space is the ultimate unyielding constraint in data center real estate.
Oh, real estate is everything.
A hyperscaler can't simply knock down a concrete wall to make room for a larger chiller. These facilities are incredibly dense, hyper-optimized concrete bunkers. If you want to upgrade a facility built 5 years ago to handle the new AI workloads, the new cooling infrastructure physically has to fit on the existing reinforced concrete pads on the roof.
Or in the mechanical yards, yeah.
Right. If the chiller is 50% larger, it literally hangs over the edge of the roof or blocks the fire access lanes. So Modine's ability to cram massive thermal capacity into a legacy footprint is what allows these tech companies to upgrade without spending years permitting and pouring new concrete.
And that backward compatibility is exactly why they noted on the call that their chiller production in North America increased 5-fold compared to the prior year.
5-fold. Wow.
The market demand for that specific geometric efficiency is just astronomical. However, the call also made it very clear that even highly optimized air cooling has a ceiling.
Which brings us to liquid cooling.
Yes. As we move deeper into the AI lifecycle, they highlighted a deliberate, aggressive shift toward liquid cooling and the deployment of coolant distribution units, or CDUs.
Now, liquid cooling is a massive paradigm shift. Water, or these specialized engineered fluids, they have specific heat capacity that is vastly superior to air.
Thousands of times more efficient.
Right. Fluid can absorb, hold, and transport thermal energy way better. A coolant distribution unit acts as, like, the cardiovascular system for this new architecture.
Exactly.
It pumps chilled liquid directly into the server racks, circulating it through highly engineered cold plates that are mounted directly onto the surface of the GPUs themselves.
It intercepts the heat at the exact moment of generation before it ever even has a chance to warm up the surrounding air.
And Modine's strategy here is a classic land and expand play. They're already selling the massive external chillers, and now they're pushing inside the building with these CDUs.
It's a brilliant two-pronged capture of the entire thermal supply chain. But, this deep integration into the AI hardware ecosystem triggered a very pointed line of questioning from the institutional analysts.
Right, the multi-billion-dollar anxiety check.
Mm-hmm.
If AI is driving this, how much of this $1.1 billion business is just a temporary AI hype bubble versus long-term cloud infrastructure?
It's the single most important risk factor for anyone evaluating the stock right now.
Because if tech giants decide they have enough processing power for the next few years and slow down their GPU purchases, does Modine's entire growth thesis just collapse?
Well, the CEO provided a very nuanced defense of their demand curve. He separated their product lines into universal infrastructure and purpose-built AI infrastructure.
Okay, break that down.
A massive external chiller is largely universal. It doesn't care if the servers inside are training a trillion-parameter neural network or if they're simply routing global email traffic.
The baseline internet.
Right. The baseline digitization of the global economy provides a massive, highly stable floor for their traditional data center cooling products.
So the baseline business is insulated from the volatility of AI.
Yeah.
But the specific AI products, like those liquid cooling CDUs,
those are directly tethered to the AI hype cycle, yes. But management relied on their direct visibility into the hyperscalers' multi-year planning models. Based on the capacity matrices they're seeing, Modine is projecting that the high-density AI infrastructure ramp-up will maintain strong compounding demand well into 2030. They do not view this as a 1 to 2 year hardware refresh cycle. They view it as a fundamental, permanent architectural redesign of the internet's physical layer.
Modeling demand out to 2030 is incredibly optimistic. But designing a jet engine on a spreadsheet is incredible. Executing it in the real world comes with friction.
Oh, a ton of friction.
Even a company growing at 73% faces the unpredictability of nature and supply chains. You can secure billions in guaranteed orders, but at the end of the day, you still have to source raw copper, assemble complex electronics, and ship massive units.
And the fourth quarter results proved that executing at this velocity is not flawless.
No, it wasn't a flawless quarter at all. Navigating storms, supply chains, and margins, it's messy. The call detailed that they lost 20 production shifts in their data center business and an additional 35 shifts in other businesses.
Entirely due to severe weather events sweeping across their manufacturing footprint in the South.
Right. And in a standard manufacturing environment, maybe losing a few days to a storm is an annoyance. But in a factory running at maximum capacity to fulfill a billion-dollar backlog, losing 20 shifts is a catastrophic sequencing failure.
It really is. A modern assembly line relies on tight, just-in-time logistics. When a shift stops, semi-finished multi-ton chillers just sit idle on the line, blocking the next stage of production.
And the hyperscalers who are timing their billion-dollar facility launches based on your delivery dates, they don't have clauses that forgive delays for rain.
This schedule is totally unyielding. So to mitigate the backlog and force the units out the door on time, Modine had to authorize massive amounts of overtime.
Paying time and a half or double time to run weekend shifts.
Exactly. And while that brute force approach protects the customer relationship, it aggressively degrades the profitability of those specific units.
The CFO noted that the weather disruptions and the overtime premiums negatively impacted their gross margins by 50 to 100 basis points.
And for anyone newer to the jargon, a basis point is just 1/100th of a percentage point. So taking a 100 basis point hit essentially means shaving a full percent off your gross profitability right off the top.
When you're dealing with a billion-dollar segment, losing a full percent of margin just to catch up on a weather delay represents millions of dollars evaporating purely due to operational friction.
Absolutely.
But weather is unpredictable, right?
Right.
Supply chains, however, are supposed to be modeled and controlled. And the transcript explicitly noted that late in the quarter, they hit severe component shortages.
This is the hidden vulnerability of scaling a complex industrial product by 70% in a single year.
Explain that.
Well, Modine doesn't mine their own copper or forge their own compressor valves. They rely on a vast web of Tier 2 and Tier 3 suppliers. If you ask a specialized valve manufacturer to suddenly double their output to match your explosive growth, their own localized supply chains often fracture under the strain.
And one missing specialized electronic controller can prevent a multi-million-dollar piece of equipment from shipping.
Precisely.
So what does this all mean? Management says these component shortages won't impact the full-year outlook, just the Q1 capacity ramp. But isn't that what every executive says right before a massive supply chain bottleneck? It's like a high-speed train. It's going incredibly fast, but the faster it goes, the more the tracks start to shake.
It's a fair concern. But what's fascinating here is Modine's proactive mitigation strategy. It tells a very different story about how they handle threats.
They aren't just sending strongly worded emails to their suppliers.
No, their response is highly indicative of a company that realizes traditional supply chain management is no longer sufficient. The CEO revealed they have actively qualified new vendors and deployed dedicated internal task forces, teams of Modine's own engineers and lean manufacturing experts to physically travel to the factories of their struggling suppliers.
Wow. They are physically stepping in to fix their suppliers' bottlenecks.
They are inserting themselves into the daily operations of entirely separate companies.
That is a staggering level of intervention. You don't send your own specialized engineering talent to babysit a vendor's assembly line unless that vendor's failure poses an existential threat to your own production targets.
It's a brute force supply chain takeover. They're re-engineering their supplier's business from the inside out to ensure the flow of parts never stops.
It shows incredible operational intensity, but it also highlights how fragile the ecosystem supporting the AI boom truly is. And it highlights a critical resource constraint: executive focus.
Yes. Bandwidth is everything.
If your leadership team is constantly fighting supply chain fires to keep the data center business running, they simply do not have the bandwidth to manage the slower legacy parts of the business.
Which brings us to the spin-off.
Right, Section 5, strategic shedding. To handle this immense pressure, Modine is taking a radical step to trim the fat from their corporate structure by spinning off its Performance Technologies segment,
The PT segment, yeah.
which is essentially the foundational history of the company. It's the division responsible for vehicular markets, heavy-duty equipment. They're formally separating it and combining it with GenTherm.
Expected to close before the end of the calendar year?
Right. And Modine is incurring $12.5 million in disposition costs just to set up standalone IT systems for the handoff.
It's the ultimate manifestation of that 80-20 discipline we discussed, but applied at the macroeconomic level.
Explain the financial strategy of this addition by subtraction.
Modine is choosing to amputate a highly complex, mature limb of their business to ensure all lifeblood flows to the rapidly growing brain of the company.
Even if it costs them $12.5 million just to facilitate giving it away.
Exactly, because if you're deploying elite engineering teams to fix advanced chiller supply chains, you cannot afford to have your chief operating officer distracted by a sudden spike in aluminum costs impacting tractor radiator margins.
It's like a band where one member wants to play smooth jazz and the other wants to play heavy metal. Both are fine, but they really need their own stages.
Great analogy. By removing the vehicular segment, Modine structurally transforms itself into what Wall Street calls a pure play entity.
A pure play climate solutions and data center company.
Right. And institutional investors love pure play companies because it allows for precise risk modeling. If a massive pension fund wants to invest in AI infrastructure, they want their capital directly exposed to the data center growth curve, not the cyclical volatility of the global heavy-duty trucking market.
Right, they strip away the macroeconomic noise. But let me ask you this, if the vehicular market is struggling, is Modine just dumping a bad asset on GenTherm, or is there a genuine synergy there?
It's very easy to look at the top-line revenue, which they described as flat to down, and assume it's a toxic asset. But the underlying operational metrics reveal a much more resilient story.
Okay, what are the numbers?
The PT team actually improved their adjusted EBITDA margins to 13% despite the lower revenues.
Expanding profit margins while revenue shrinks is incredibly difficult.
It requires surgical cost-cutting and immense internal discipline. It proves the PT division is not a bloated, distressed asset. It's a highly tuned operation successfully navigating a brutal macroeconomic cycle.
So it's not a bad asset, it's just a completely different business cycle than the hyperscale data center boom.
Exactly. Combining it with GenTherm, a company whose entire operational DNA is focused on vehicular thermal management, unlocks massive economies of scale for that specific industry.
Okay, so with the vehicular business exiting stage left, what does the financial crystal ball look like for this new, streamlined Modine in fiscal 2027?
The forward guidance is astonishing.
Let's hear the numbers. Section 6, forward guidance, and the bottom line.
For fiscal 27, Modine projects total company sales growth of 20 to 35%. But within that, the data center segment is expected to grow an astonishing 60 to 80%.
Upgraded from their previous 50 to 70% estimate.
Yeah,
right?
and commercial HVAC is projected to grow 5 to 10%. But the real kicker is profitability. Total adjusted EBITDA is guided to $650 to $680 million.
Which implies what for the margins?
It implies a 100 to 200 basis points of margin improvement across the enterprise.
Okay, predicting 60 to 80% growth is like calling your shot in the World Series.
Yeah.
Very few companies project 40% earnings growth at this scale, let alone 60 to 80 in a specific segment.
It's a massive upward revision. You're publicly daring the market to doubt your capacity.
But if you're battling supply chain issues and raw material inflation, how do they plan to actually achieve this margin improvement?
The mechanism protecting those margins is entirely contractual. They utilize highly sophisticated pricing mechanisms embedded directly into their master service agreements.
Pass-through clauses.
Yes, raw material pass-through clauses and tariff escalators. If the cost of specialized metals spikes by 20%, Modine simply recalculates the final invoice, and the hyperscaler absorbs the inflationary impact.
But there's usually a lag there, right? You don't buy copper at a premium on Tuesday and hit the customer with a surcharge on Wednesday.
Right. The transcript noted there is typically a 3 to 6 month lag before these contractual price adjustments fully take effect.
So they might take a temporary hit to margins in Q1, but recoup it by Q3.
Exactly. It acts as a trailing shock absorber.
Navigating that latency requires deep cash reserves. Which brings me to playing devil's advocate on their leverage strategy.
Let's do it.
The call revealed an $84 million increase in net debt, bringing their total to $363 million to fund acquisitions and CapEx. Are they over-leveraging themselves for this growth? If the market cools, servicing hundreds of millions in debt with half-empty factories is how industrial companies collapse.
It sounds aggressive, but if we connect this to the bigger picture, the narrative flips to highly conservative capital deployment. The defining metric is the leverage ratio.
Debt versus EBITDA.
Right. Modine's current leverage ratio is sitting at 0.8.
Which means if they took every dollar of operational cash flow over 12 months, they could pay off their entire debt with money left over.
In an industry defined by heavy machinery and global logistics, operating with a leverage ratio under 1.0 is almost unheard of. Many fundamentally sound manufacturing companies carry 2.0 or 3.0.
So 0.8 means they have a fortress of a balance sheet. They have plenty of financial breathing room.
Immense strategic optionality.
Well, when you pull all these disparate threads together, the 80-20 discipline, the $4 billion LTA, the 3-megawatt chiller, the spin-off, it paints a vivid picture of the sheer physical effort required to sustain the digital world.
It really translates Wall Street hype into factory floor reality.
It does. Modine has successfully transitioned into a crucial bottleneck player for the AI revolution. And for you listening, whether you're investing, working in tech, or just turning on an AI chatbot today, you have to remember that the physical reality of the internet requires massive amounts of moving air and chilled water. Companies like this are the unseen backbone of the digital age.
They absolutely are.
But, it leaves a truly fascinating, deeply complex problem sitting on the horizon. We've tracked how Modine has maximized air cooling with the 3-megawatt system and how they're migrating to liquid CDUs. But the roadmap for AI processing power does not end here.
Not even close. As AI chips become exponentially hotter, we will eventually hit the limits of physics with air and water cooling.
There's a fundamental ceiling.
Exactly. So what happens when data centers are forced to move completely underwater or require two-phase immersion cooling where servers literally boil specialized fluids to carry the heat away?
The $4 billion contracts today are just a stopgap. The true question isn't just about building chillers today, it's about what bizarre science fiction cooling tech will be required a decade from now just to keep the intelligence of the future from literally burning itself to the ground.
It's going to be a wild decade.
It really is. Thanks for joining us on this deep dive, and we'll catch you on the next one.